Welcome, everyone, to today's Explainer. If you've ever felt completely defeated by choppy price charts or experienced the absolute sheer frustration of getting trapped in a sudden, violent, false breakout, well, you are in exactly the right place. Today, we're focusing on a cure for the very real pain of getting chopped up in sideways, non-trending financial markets. We are going to unpack the absolute genius of Dr. Al Brooks. He's a former eye surgeon turned legendary day trader, and his landmark work on trading ranges is honestly a total game changer. We're going to see exactly how his strategies completely rewire how you look at a sideways chart, transforming what honestly just looks like random market noise into a highly structured, highly predictable landscape.
Okay, let's dive into this. The sideways market trap.
Here is a statistic that is a massive wake-up call for most retail traders. Ready? Financial markets spend approximately 80% of their time trapped in trading ranges and only 20% of their time actually trending. I mean, really think about what that means. Almost all the mainstream trading advice out there, the fancy indicators, the classic trend-following strategies, the age-old mantra of let your winners run, it's completely invalid for 80% of the trading day. If you're out there trying to force a trend strategy onto a market that is fundamentally just moving sideways, you are fighting market inertia. And honestly, you're just going to slowly bleed your capital dry.
Which brings us to the core conflict of sideways markets. This is a question I really want you to keep in the back of your mind as we go through this. Why do 80% of all breakout attempts fail? Why is it that the exact moment a chart looks like it's finally breaking free, it just violently reverses direction? Well, the answer entirely lies in who is actually controlling the market at those extreme boundary edges.
That takes us to the retail versus the institutional mindset. To really understand those boundary edges, we have to look at the players involved. You see, a trading range isn't just chaotic noise. It actually represents a state of deep institutional balance. Think of it like a massive horizontal tug-of-war where both buyers and sellers essentially agree on a fair value consensus. And what's really interesting about this dynamic is the complete, literal opposite behavior between retail traders and institutional traders at the edges of this fair value zone. When a massive green trend bar surges toward the top of a range, what happens? Retail traders experience this sudden, intense fear of missing out. They panic by that high, convinced a breakout is happening. But institutional traders? They view that exact same surge as a gift. They fade the breakout. They sell short to those panicking retail buyers because they know the market is simply overpriced relative to that fair value balance. Institutions are fading the edges while retail traders are getting completely trapped in them.
Al Brooks describes this shifting momentum using a really brilliant concept called the always-in state. Basically, it asks this: if you are forced to hold a position right this exact second, would you be long or would you be short? Now, in a strong, clear trend, the always-in direction is super obvious, right? And it stays that way for hours. But inside a trading range, this state shifts violently back and forth. A big two-bar green spike makes the market look always-in long, but then it hits resistance, forms a nasty red reversal, and instantly flips to always-in short. This constant aggressive flipping is exactly what generates those endless false signals on your standard indicators.
Because of this violent flipping, Brooks points out that your strategy absolutely has to adapt. In the exact middle of a trading range, the always-in bias is completely neutral. The probability of the market moving up or down from that exact midpoint is roughly equal, which means your risk-to-reward ratio is just terrible. You must avoid trading in the middle of the range at all costs. Patience is absolutely essential here. You literally have to sit on your hands and wait for the price to stretch to the extreme outer boundaries before you even think about putting on a trade.
So let's look at the actual anatomy of these range traps.
We're talking about the breakout failure trap, and let me tell you, it is one of the most consistently profitable setups you can possibly master. Here are the actionable steps. First, you wait for a breakout bar to punch right through a major resistance or support level. Retail money is aggressively buying that breakout. Second, you wait for that bar to fail, meaning the very next bar is a strong reversal candle that closes right back inside the range. Finally, you place your entry order to trade in the exact opposite direction of that failed breakout. By doing this, you are aligning your orders right alongside the institutional money. You get to ride the momentum downward as all those trapped retail buyers are suddenly forced to panic sell at a loss just to cover their bad positions. It's a beautiful thing.
But Brooks issues a major warning about a very specific type of range trap. He calls it barbwire. Barbwire is an incredibly tight trading range. We're talking about a super narrow price channel with heavy, messy overlap between the bars and just a bunch of alternating red and green dojis with long, choppy wicks. It is an absolute cognitive and financial minefield for retail traders. There is simply no room to profit here. The vertical distance is so incredibly small that every single time you buy, you are almost immediately squeezed out by the very next bar.
Brooks emphasizes this heavily, and you really need to hear it. When a barbed wire formation appears on a chart, the absolutely best move is to stand aside completely. Don't touch it. The market is in a state of hypercompression. It's storing energy like a tightly coiled spring. Predicting which way it's going to break is a 50-50 coin toss at best. The only winning move here is to preserve your mental energy, protect your capital, and just wait for a definitive, decisive breakout.
Let's move to and see how this builds into high-probability trade setups.
Brooks completely redefines how we need to look at double tops and bottoms. Seriously, forget the perfect geometric M or W shapes you see in classic beginner textbooks. In a sideways market, every single move to the top of the range is a double top test, and every move to the bottom is a double bottom test. They do not have to be perfectly symmetrical. You're going to see lower high double tops, higher high failures, and all their messy variations at the bottom too. A trading range is essentially just one massive, ongoing series of these overlapping tests. And sometimes you'll notice the market actually needs a third attempt to really exhaust the buyers or sellers. This forms a wedge. What you're looking for here are three distinct pushes in price. With each successive push, the actual bodies of the candle shrink, and the momentum clearly diverges. This is a classic exhaustion pattern. When you see three aggressive efforts to break out of a range, and they are just instantly absorbed by the institutions every single time, well, you have the perfect setup for a sharp, high-probability reversal back to the mean.
Now, another incredibly vital tool in spotting these setups is the 20-period exponential moving average, or EMA. In a trending market, this moving average slants heavily up or down and acts as a dynamic floor or ceiling. Price just naturally bounces off of it. But in a trading range, the moving average flattens out completely. It cuts right through the dead center of the price action. Instead of acting as support, it actually transforms into what Brooks calls a central magnet. When price gets way too far away from this flat line, it becomes fundamentally overextended, and the algorithms will inevitably pull it right back to the mean.
This leads to a truly brilliant dynamic at the extreme edges of the range. Brooks notes that support and resistance actually act like rubber bands, stretching temporarily but ultimately pulling price right back to the center. The outer edges of a range have this incredible magnetic pull because, well, that is exactly where all the liquidity is sitting. All the retail stop-loss orders and breakout limit orders are clustered right there. So price will often speed up right as it hits the edge, stretching that rubber band to the absolute max to execute those orders before violently snapping right back toward the middle.
So the crucial point is psychology and risk mastery. In a trend, sure, you absolutely want to let your winners run. But in a trading range, Brooks notes that greed is an absolute killer. Traders must adopt a scalp trading mindset. If you buy at the bottom of the range and the price moves halfway up to the middle, you need to be actively taking partial or full profits, period. If you just sit around hoping for some massive, multi-point breakout trend, I guarantee you will watch your open profits totally vanish as market inertia asserts itself and the price reverses right back to your exact entry point. Take quick profits. Don't be greedy. Risk management is also structurally very different here. As a general rule, you should always be risking a fixed 1 to 2% of your capital per trade. But in a range, your stop loss absolutely must go entirely beyond the structural support or resistance level, or beyond the absolute high of the failed breakout bar. Because these logical structural stops can sometimes be surprisingly wide, you actually have to adjust your position size downward. Taking smaller position sizes is what allows you to survive the wide volatile swings at the edges without ever blowing past that strict 1 to 2% risk limit. This highly structured approach is exactly what allows you to take advantage of failed setups. For example, let's look at a high 2 pullback. That's a classic bread and butter trend continuation signal, right? But when a high 2 forms right up near the ceiling of a trading range, it instantly becomes a trap. Retail traders eagerly buy the high 2, totally expecting a breakout to the moon. Institutions, on the other hand, fade it. When it fails, all those retail buyers are suddenly completely underwater. So, a failed high 2 up near resistance actually becomes a fantastic, high-probability short setup for you, specifically targeting that trapped retail money. Which leaves us with one final, absolutely crucial thought. The biggest hurdle to mastering trading ranges isn't technical, it's psychological. As humans, we naturally want the market to move in smooth, clear,
easy-to-read trends. But the reality? The market spends 80% of its time in a messy state of horizontal balance. So are you ready to stop fighting the chop, detach your ego, and actually start profiting from market inertia? The next time you pull up a sideways chart, don't get frustrated. See it for what it truly is, a highly predictable arena full of trap traders and rich, totally exploitable opportunities for the disciplined learner. Thank you so much for joining me on this explainer, and keep studying those charts.